Hello, Robert Nordlund here from Association Reserves. Wanted to say hello and introduce you to a new resource that we've developed. It's a little handout called Why Reserve Studies, designed to help explain what's in a reserve study and the value of a reserve study. Hope you enjoy this. Follow along with me for a few minutes as I walk you through this new resource. As I indicated, it's a handout called Why Reserve Studies. It's designed to help people understand what a reserve study is and isn't. Basically, we see reserve studies as helping to reveal the true cost of home ownership at an association. So people are paying their fair share along the way, taking care of ongoing deterioration at the association. In a reserve study, it's important to know what you get. The reserve study has three key results. There's the component list, the reserve fund strength that's calculated based on that component list, and the funding plan that again is calculated based on the starting reserve balance and the component list. So I want to make sure you caught that the reserve fund strength and the funding plan are both calculated based on that foundational component list. Now the component list is based on a diligent visual site inspection and the measurements taken in that site inspection if it's a full reserve study. In an update with site visit reserve study, that component list is reviewed and updated based on a diligent visual site inspection. And there's the update no site visit reserve study, where the component list is updated based on communication with the client, years since the last reserve study, and communication with important association vendors. But the component list is the foundation, the reserve fund strength calculation, and the funding plan, the calculations are based on that component list. So it's worth spending another moment describing what's in that component list and how we know that we're getting the right components, all the right components in the component list. So there's a national four-part test, comes from National Reserve Study Standards, that helps us make sure that we're catching the right things. First off, it needs to be a common area maintenance responsibility, not something owned and maintained by an individual owner or the management company or the developer. It, of course, needs to have a limited useful life. There's no sense setting aside reserves for permanent components. It needs to have a predictable remaining useful life. Again, you can't budget for something that you don't know when it's going to occur. And it needs to be above a minimum threshold cost. The low cost, almost trivial items are things that are best absorbed into the ongoing maintenance budget. And that resulting component list can be described as giving you two types of information: the scope of your reserve projects, which is the description of which projects you're doing and the cost of them, and the schedule of those reserve projects, when they're going to occur in the future. And then I can move on, once you've got that reserve component list, talk about reserve fund strength, the second of the three results. Reserve fund strength is a comparison of the cash that the association has in reserves on the first day of the fiscal year compared to the calculated deterioration of its reserve assets. It reveals how well the association's reserve fund has kept pace with the ongoing daily deterioration. If there's more deterioration than cash, then you know that reserve contributions haven't kept up. And that's the case that most associations are unfortunately in the United States. It's important to know that number because the percent funded, the measurement or the term by which we measure reserve fund strength, reveals the size, because we don't report reserve fund strength in terms of cash. It's reported in terms of a balance between the reserve fund size and the deterioration size. So the ideal is that balance point where an association is 100% funded, where reserve cash is equivalent to reserve deterioration. And then you can go down into the fair and poor range. Another way to look at it is not just what we describe it, but what are the implications. In the strong range, 70 to 130% funded, there's a low risk of special assessments. The opposite is true. Go over to the right-hand side of the screen, you'll see that in the weak range, what I described on the last chart is the 0 to 30% range, we find there is a high risk of special assessments among our clients. Most associations in the United States are in the 30 to 70% medium range. And finally, we move on to the third result, the funding plan. How do we do that, and what are we trying to accomplish? Well, again, according to National Reserve Study standards, we're trying to accomplish 4 things with the funding plan. We need to fundamentally make sure that the association is prepared for the timely execution of those anticipated projects, the scope and schedule that we defined in the reserve component list, by providing sufficient cash. We're trying to also provide a stable contribution rate so the budget is consistent through the years, that it's evenly distributed over the homeowners so everyone is paying their fair share over time, and fundamentally that it's fiscally responsible, that the board can rest comfortably knowing that they have been responsible in taking care and providing for the assets of the corporation. Now, another way to look at it is like a dial, how hard you or how fast you're putting reserves into the association. Just right is when you're fully funding reserves, when the reserve cash is equivalent to the deterioration rate there at the association. Baseline funding, actually just a little bit less, is when you allow the cash in reserves to drop down to basically a zero balance. And of course, if you contribute less than that, that means not enough. That's insufficient amount of reserve contributions going to the association's reserve fund, and they'll result in special assessments and deferred maintenance. Of course, the opposite is true. If the association contributes too much to reserves, they'll develop a surplus, and that's retained earnings, and that's not good for a not-for-profit community association. Now, there's multiple ways to put cash into reserves. There's the regular budgeted reserve contributions, and there's some lump sums. The most common type of a lump sum is a special assessment. That's inherently unfair. That's destabilizing towards the budget, so that's not the preferred way to make reserve contributions. It's also the least expensive way to make reserve contributions is through the budgeted reserve contributions. Special assessments and loans are a very expensive way to pay for ongoing deterioration at the association. And I want to conclude by helping you see that a financially healthy association is able to have success and to make the common area repair and replacements in a timely manner without those expensive special assessments. What we're trying to do here is have all the owners pay their fair share over time, providing financial stability to the association and minimizing the chance that the association will subject to any unfortunate financial surprises. And if you need additional information, you can always go to our website, reservestudy.com, where you'll find information in our Learning Center and specifically our library there. And you can find articles and videos and additional resources on general topics and specific topics having to do with the component list, reserve fund strength, and the association's funding plan. Anything else we can do for you at Association Reserves, please be in contact with us. We want to be your resource for all reserve study issues. Thank you very much.